As we stand on the brink of a looming debt crisis, the conversation around negative real interest rates is more relevant than ever. In this video, we'll explore how mounting debt levels and persistent fiscal deficits are forcing policymakers to reconsider unconventional measures, including negative real interest rates on U.S. Treasuries, what effect that might have on markets, and how to protect yourself. We'll analyze the intricate relationship between these rates and key economic indicators like growth and inflation, and understand this dynamic in relation to GDP. So here is the fiscal, the nominal number, and then in red is that deficit, that gap, as a share of overall GDP, which is gross domestic product. That is the output of the American economy. We can see that the nominal deficit, we ran relatively balanced budgets coming out of World War II, or 90s. Well, what has happened since? This is .com here. This is 2008 here. And then this is $280 billion deficit. Well, we recovered, quote unquote, but we only got back to $1.4 trillion deficit. So the deficit was worse. Coming in red is the deficit. GDP really kind of started in the late 70s, right? So this was surplus as a share of GDP. But in general, the same general trend. It's important to point out we are currently at about a $2 trillion deficit, or 6% of GDP. This level already has only ever been seen in World War II and 2008, and of course what happened in 2020. Generally speaking, the government will run a deficit during a crisis to help kind of stimulate and get us out of the crisis. But we have never seen a situation where we are running a 6 or 7% of GDP deficit with full employment, right? No world war. So the context, the starting point is already kind of never seen before. And this goes back, this is not a recent phenomenon. This goes back 2, 3, 4 years to the prior administration. It's important to put as a share of GDP to about 7 or 7.5%. Again, utterly insane, never seen before outside of World War or deep recession, economic crisis. Here in blue, we have debt, just the nominal level of debt. But in purple, again, is what really matters. This is debt to GDP. We can see the last time we're currently about 122% debt to GDP. We have been here before, and it was after World War II. We can see the nominal debt increased very sharply during that World War II era, and has been increasing ever since. But the point here is that debt to GDP can actually decline even as the debt grows, right? Because remember, with this relative chart, debt to GDP, if you grow GDP faster than you grow the debt, this purple line will go down. You can be growing the debt as long as you're growing GDP faster than you're growing the debt. This purple line will go down. So here is the U.S. inflation rate and the real GDP year over year. Again, this is how economists think of inflation. And a couple things that I think are worthy of pointing out here. So here, this dotted red line is 0. Coming out, the last time debt to GDP was this high, coming out, in World War II, coming out of it, I want to point out to this inflation rate. We don't have real growth, unfortunately, going back that far, but inflation in 1947 was as high as 20%. Inflation in 1942 was as high as 13%. Remember, during 2021, the peak of inflation here, 2022, was 9%. This is only, when we're talking about 19%, that's double what we just saw. And most people know how painful that was. And so just to establish what these terms are, so that is inflation. Here in blue is real growth, right? This is the inflation adjusted growth. And that's called real GDP, year over year change. And then in red, we have nominal growth. This adds the two, inflation and real growth. It adds both of them together, and now you get nominal growth. Well, what do we see? We see kind of this rising nominal growth environment. Remember, this is real GDP growth plus inflation. And we saw real growth, like real substantial growth coming out of World War II, where, here in 1979 at its peak, before it started its kind of decline, it was as high as 17%. So call it about 1980. We had 17% nominal growth. Currently, we're talking about like 4%. And you can see that in general, this nominal growth, remember this growth plus inflation, this has been declining ever since 1980 for the past 40 years or so. Well, there are some historical analogs that we can look at and for historical context. So here is a long-term interest rate cycle chart. This goes back to 1970. And what we can see is these kind of 30-ish year cycles of interest rates. And this goes back again all the way to basically the creation of the US. Interest rates move in general about 30-year cycles. Remember, the business cycle is about 3 or 4 years. This is the refi cycle, as Michael Howell puts it. This is the business cycle that if you've taken economics, this is what the business cycle is, 4 years. It's also our political cycle, about 4 years. Well, there is this larger 30-year cycle. Well, within that, there is an even larger cycle. Ray Dalio talks about this stuff a lot. There's an even larger cycle. There's a long lifetime cycle of about 80, 90 years or so. And you can see both the 30-year cycle reflected here, as well as that 90-year long lifetime cycle that the structural demographic proponents like Neil Howe, Peter Turchin, that is where they draw. And so here is interest payments as a share of GDP. And again, you can see this kind of 30-year cycle with interest payments. It's important to point out where we are going back all the way to 1800s. The debt service, the cost of the debt relative to the size of our economy. Look at how high it is currently. I mean, it's actually about 4%. This data is not super current, this chart. It's actually about 4%. We've never seen this before. And so the historical context of the interest cost is important to point out. Here are two different measures that came out of Peter Turchin's book, Ages of Discord. Here's revenue as a percent of GDP. This is how much the government is collecting in tax revenue as a share of GDP. Again, let's look at the overall context in American history. The government is collecting a huge amount of tax revenue. It's lower than 20%. Currently, it's about 17%. And we can see that it's basically gone sideways going back all the way to World War II. Revenues have grown at the same rate as the economy has grown. Well, debt has not. Here is a longer term debt to GDP chart down here. We can see it going all the way back to the late 1700s. And again, this is lagged. I think the book came out around the GFC. Currently, we know debt to GDP is about 122%. That actually makes the all-time high above World War II. But again, the long lifetime cycle that he talks about and the 30-year cycle within that. Here, he measures this elite and counter-elite and kind of societal dynamics. In this top chart, he takes inequality, tuition, polarization, political polarization, and finds an average. All of this stuff, there's equations in the book, and it's all very well cited and explained. And again, you can see these kind of long lifetime cycles, this 80-year cycle in this kind of general social strife measure. Here in the lower pane is the elite, a score of how the elites are doing versus a score how the average person is doing. They are inverse. And you can again see this kind of long lifetime cycle, this 70, 80, 90-year cycle. Here is an interesting one. This is the cost of tuition at Yale expressed in terms of the annual wage. So I do a lot of these kinds of charts, but this one's, one I don't have access to tuition data, but again, you can see these kind of longer cycles playing out in that chart as well. So here is CPI. Here is inflation in purple and the 10-year yield in white. So there's a number of things to point out here with this general concept here. So we're talking about the real yield. We mentioned it in the intro. The real yield. This is the above inflation. How much yield are you really getting? And a lot of people point to World War II and go, well, debt to GDP was this high before. Well, just, we were fine back then. Actually, debt to GDP got better, right? Debt to GDP actually came down. We'll just do the same thing, okay? So what did we do? Well, we can see here from the data that we capped rates. From 1941 all the way through to like 1950, the 10-year Treasury yield in white never got about above 2.5%. Well, what was inflation doing? What was the purple line doing? We can see in 1942 it was 12%, actually 13%, and then in the mid 40s, in the later part of that decade, we can see it was as high as 20%. But meanwhile, if you were buying bonds, you were only getting compensated 2.5% per year. What this means, this is a negative real rate. We capped rates, yield curve control, where we said, nope, bond market, you are trying to demand the yield to compensate you for what you think inflation will be. We are preventing you from doing that. We are telling you you are not getting anything higher than 2.5%. They had capital controls essentially and yield curve control, and we ran the economy super hot. Remember nominal growth here, what it was doing post World War II, and it wasn't just the immediate just coming out of World War II. This trend continued for a long time, and debt to GDP fell during that entire time, right until 1980 at its low of 30%. Inflation was higher than the Treasury yield. Now, this was the case across the curve. It didn't really matter the duration, but I'm using the 10-year Treasury here. And so what you see is this huge gap where inflation is running way higher than the interest you're getting on U.S. Treasury bonds. This is called a negative real yield. And here in red is it's the same data we're looking at up here, just presented in a different way. I took the 10-year Treasury yield and subtracted CPI. And so you get this a real yield measurement. This dotted red line shows zero. So anytime the red line goes above, this is a positive real yield. And anytime it falls below is a negative real yield. This means, right, if you buy $1,000 worth of Treasury bonds, you will always get your $1,000 back. A negative real yield, what that is implying is not that you won't get your $1,000 back. You will. The problem is the $1,000 you get back will not buy you the same amount of real things, right? This is called financial repression. The debt is being inflated away. When people say that, this is what they're referring to, a negative real yield. And you can see, depending on which kind of area makes it easier to understand. Either when the purple line going above the white line is one way to kind of visualize it. And we can see, substantially negative real yields here in the 40s, right? It's just two ways of looking at the same data. We'll put the other way when the cost of the debt is higher than the inflation rate. That's the exact opposite. You are getting a premium above inflation to buy Treasury bonds. This makes it harder for the government to service its debt, and the debt load gets harder for the government. And what I want to point out is this is peaking in 1980, both CPI, right, peaked at about 14% here in 1980, and the 10-year Treasury yield peaked just above it at 15%. This is a monthly chart. And ever since then, both inflation, generally speaking, and the 10-year Treasury yield have been falling. Not only that, but look at the real yield. Look at the inflation adjusted rate of return. That is falling as well for that same period of time. This means the government, it is less of a burden for the government to take on more debt. It is getting easier as this line falls for the government to take on more debt. Think of this as a credit card, right? If you're paying 29% today, but some company offers you 0% tomorrow, you're going to probably increase your debt. This is why the debt crisis that some people were worried about in the 70s, 80s, 90s, this is why it never came to pass. Negative real rates. The inflation adjusted premium that the government had to pay on the debt was falling, right? And if anything, it has been very low going back to 2008 and the GFC. Well, what has started to happen? Not only have we broken above 0% after having negative real rates for about 6 years, not only have we had negative real rates and we're going above the dotted line and above zero, but we're also breaking out of this long-term 45-year long-term cycle. This is why I mentioned that long-term cycle in the beginning. Here is nominal growth in the 10-year Treasury yield. Here we were just looking at CPI or inflation, right? And the difference between the 10-year Treasury yield and just inflation. Here we're looking at the difference between the 10-year Treasury yield and nominal growth. So this is taking inflation, this purple line, and adding in real GDP. That is what nominal growth is real growth, real inflation adjusted growth plus inflation. And that gives you nominal growth. And again, very similar kind of concept. When nominal growth is higher than the cost of the debt, right? When this red line is above the white line, look at what happens to debt to GDP. Look at all the time that nominal growth was running really hot, and look at what happened to the debt load. It decreased. Well, what has started to happen, following, call it the mid '90s, is really when this kind of trend started to shift. We see, there was a good period of time there where the 10-year Treasury was actually higher than nominal growth. Well, what have we been doing recently? We've had nominal growth, generally speaking, above the cost of the debt. Well, what has started to happen? Nominal growth has actually, it's been falling for 4 years, and the 10-year Treasury yield is rising. So this means that the cost of the debt for the government is getting more difficult to service. Look at nominal growth, right? Going back all the way to 2011, coming out of the GFC, we can see that nominal growth has been above the cost of the debt. The economy, the denominator, was growing faster than the numerator. The problem is that the cost of the numerator. The problem is that this has started to reverse, right? We're seeing the cost of the debt start to be higher, right? Look at the general direction of travel here. The cost of the debt is moving higher as nominal growth is moving lower. Remember, nominal growth, the red line, is what the government uses is the economic activity that the government uses to service the debt. And the white line is the cost of that debt. So here is debt to GDP in blue. And then here in white is that 10-year Treasury minus nominal growth. Again, it's the same way of looking at this the same data here in red and white. It's the same data, just presented a different way. I took the 10-year Treasury yield and minused out nominal growth. And so anytime this white line is below the dotted line, you have the 10-year Treasury yield is lower than nominal growth. And hopefully the color coding makes it really simple to see this concept. As the cost of the debt is lower than nominal growth, the debt load is getting better for the government. And we can see debt to GDP decline as the cost of the debt, the interest the government has to pay, is lower than nominal growth. We can see this relationship as it moves above 0%, and you have the cost of the debt be higher than nominal growth. You can see debt to GDP increase. And this is the case. I marked a couple inflection points, but hopefully this correlation is clear. Well, what do we see recently? We see, not only is it breaking out of this kind of long-term downtrend, but it is moving above 0%. You are starting to have the 10-year Treasury yield higher than nominal growth. And again, this puts increase in pressure on the government and servicing the debt. So here's kind of starting the what to do about it discussion about this. So here's gold and the 10-year Treasury yield. And historically, right, we had the gold price that was fixed until 1971, basically, when it was kind of the peg was broken, the Nixon shock. We basically defaulted on in a way, but the gold price was fixed, so we can't really look to World War II. And then the severely negative real rates that we saw in World War II, we can't really look to gold because the price was fixed. But we can look to kind of much more, recent sort of values for gold and how it's performed recently. And so here is that. Here's the 10-year Treasury yield. Here's gold in yellow. I will add, excuse me, in red. So here in red, we have gold. And what I want to point out, I'll take GDP off, debt to GDP off here. What I want to point out with gold is that historically speaking, when the 10-year Treasury yield is higher than inflation, right? Think of this another way. If you're buying Treasury bonds, the government is incentivizing you to do that by paying you higher amount than nominal growth, right? You are getting a premium above nominal growth. It has been bad for gold. We can see the gold price in US dollars decline during an increase in that premium. And this makes sense because gold doesn't give you a yield. It just sits there. Um, and meanwhile, you are getting ever more premium to buy, ever more return to buy treasury bonds when this white line is moving higher. And so we can see, as a white line moves higher, the gold price moves down. Same thing here. Gold has a dip, right, as the real rate of return is spiking, and there's this kind of inverse correlation. Hopefully, that inverse correlation is clear. Well, what do we see recently over the past like 2 or 3 years? We see them moving together. We see gold price moving higher in red, and then we see the real premium above inflation also moving higher. This is the 10-year Treasury yield minus CPI, minus inflation, not nominal growth. Very similar concept, but just here we're looking at the traditionally defined real rate, and that is 10-year Treasury yield minus inflation. So you have been getting an increasing premium, right? At the low, you had a -6% return, right? That's a negative real rate of return on Treasuries on the 10-year. That was in 2022. And since then, you've gone from a -6% return all the way up to a positive 2% return. That's an 8%, 8 point move. And meanwhile, what has the price of gold done? It's moved from about 1700 all the way up to 3400. This is a logarithmic chart, this red line, this gold chart. Uh, and it adjusts for exponentials. I will throw on what it looks like in regular terms. And so you can see that this, what had been an inverse correlation, now they're moving in the same direction. Well, why is this happening? This was all the talk in 2023 or 2024 when this started to really kind of people started to notice this correlation breaking. The reason is because the gold market is sensing growing fiscal issues, growing debt issues. And the gold market knows, just like the bond market knows and is waking up to, that the only way for the government out of this kind of debt issue is to run inflation and the nominal growth hot, right? To run inflation hot, to inflate the debt away. Financial repression is the technical term, where you are running the cost of the debt is lower than the nominal growth you're getting, right? This is what we did after World War II. This is called financial repression. We've done it before. We capped rates back then. It's very inflationary, as we pointed out. The inflation rate or the nominal growth was 20%. Inflation was like, 19% at the peak there. So we know kind of what that playbook looks like. And gold is a scarce asset. Remember, the value of gold doesn't really change much. It can change around the margins with kind of it can now be used for shielding on space equipment, right? There's always like industrial uses for gold, and some technological advancements that will drive the gold price higher. But in general, the vast majority of the value of gold is as a monetary unit, as a monetary asset, and so it behaves relative to debasement, currency debasement. Remember, there's only so much gold in the world, and so when the price of the gold price in dollars is going up, the other way to think about that is that this is what's happening to the value of the dollar, the purchasing power of the dollar. It is going down, right? Your wage is your wage. Unless you're getting a raise based off the gold price, every time the gold price moves, your wage is your wage. As gold is getting more expensive, that means that your wage in gold terms and real terms is being devalued, right? You are working the same amount of hours, but you can get less gold, right? What might have taken you a week now takes you 2 weeks to get 1 ounce of gold, right? So it's really important for people to understand this concept of scarcity. And when money is flooding the system, in a financial repression regime, a negative real rate regime, it is very inflationary. Well, there's only so much gold, and the price of gold must go up. If more money units flood the system, the price of gold will go up, and not because gold got more valuable, just because there's way more monetary units chasing the same amount of gold. Supply and demand imbalance, price must go up. This is very, similar to the housing situation. So we created 40% of all the money ever created in the US history, 40% of it was created during from 2021 to 2023. What do you know? The price of a average single family home went up 40%. Is not because the home got more valuable. The home is still a box that you live in, right? It might have gotten marginally more, tech or something, but we're talking like 2, 3, 4%, right? The vast majority of the increase in the housing price is not the housing got more valuable. It is that the dollar lost that much purchasing power. It is the same exact thing with gold. So in a regime where there's, huge amounts of money printing, currency debasement, financial repression, negative real interest rates, scarcity becomes super important. Now, scarcity is not the only element, right? There is also elasticity. This is a concept where, let's take gold. So gold, take it to the extreme, right? The extremes inform the means. Say the gold price 10x's overnight. You wake up tomorrow and gold is trading at $30,000 an ounce. Okay, well, a lot of people are going to be incentivized to go find gold, right? Because now you can suddenly get 10 times more US dollars for the same amount, right? So it incentivizes a bunch of people to go flood, go out in the mountains and start mining for gold, and, in the rivers, right? Trying to find gold. That is called elasticity. The same is true for stocks, right? Stocks can be printed out of thin air. Same example, let's use Apple. Say the price of Apple shares 10x's overnight. Apple can go, whoa, that's our company is really overvalued. This is a great time to raise money. Let's print a bunch of shares, which they can do, sell them onto the market, thereby increasing the supply of shares. And the price will come down, right? Apple will get the money. People will pay them for the shares. Apple will get cash dollars, and the price of Apple shares will fall. There's elasticity with stocks. The same is true with real estate, right? Take it again to the extreme. Say the price of a house 10x's overnight. Well, all those home builders and probably a bunch of new ones are going to go build a bunch of housing. And what do you know? As soon as that supply comes online, right, as soon as they finish the housing units, the price of the house will fall. That is elasticity, the ability for new units to kind of come into the market. Well, gold has elasticity. Stocks have elasticity. S&P has, stocks have elasticity. What does not have elasticity? Really, the only or the most inelastic asset, objectively speaking, probably right now is Bitcoin. Um, I know there's a lot of people that still hate Bitcoin for some reason. I don't. If you hate it, that's okay. I'm not trying to convince you of anything. But just objectively speaking, not only is it now the most scarce asset, is actually now the most inelastic asset, right? So let's apply those same concepts to understand why Bitcoin has the best characteristics for this kind of profligate spending financial repression regime. So elasticity, let's look at that. So Bitcoin, there's only new Bitcoin coming into the supply every 10 or 15 minutes, right? That is set. That is not going to change. If anything, that new Bitcoin amount of 2 Bitcoin per 10, 15 minutes, that will decrease over time. Every 4 years, this is why Bitcoin does these kind of 4-year things. Every 4 years, there's what's called a halving, where that new supply amount gets reduced by 50%. So, what maybe back here in 2017, it was 8 Bitcoin per 10 minutes, right? Every 4 years, that gets cut in half. And so the new supply is always, kind of gradually being reduced. So there is kind of the opposite of elasticity. And then when you look at scarcity, the Bitcoin supply is growing about, I think, 1.7% on an annualized basis. So every year, currently, right before the next halving, it is 1.7% new supply every year. Gold is about 2.4, 2.5%. So they are both very scarce, and I think they will both perform very well in this kind of environment. But Bitcoin, objectively speaking, is more scarce, and in by the next halving will be even more scarce by the next halving. in 3 years. And again, elasticity, only so many Bitcoin can come on every 10, 15 minutes, new supply. That is set. That cannot change unless all the kind of consensus of all the network decides to do that. Right, that is not in anyone's best interest. That won't happen. But the elasticity there is basically the opposite of elasticity. The Bitcoin price could 10x overnight, but only two Bitcoin can be kind of created every 10 minutes. No, it is not the case with gold. That is not the case with any other commodity, really. This is something that's kind of unique to Bitcoin. Part of the reason that I think we've seen it go from, 20 cents to over $100,000 is both the scarcity element, right? It is actual scarcity, um, but it is also a lack of elasticity. And look, gold, I think will do very well. I think both of them will do very well in this kind of environment. Um, let's look at stocks. So here is the S&P 500 divided by gold. And remember, if the numerator is growing faster than the denominator, that yellow line will go up. We can see that in the periods of time with these kind of positive premiums for bonds, S&P tends to outperform gold. Remember, gold does poorly. So the opposite of that is also true, which is that in a negative interest rate environment, as rates the rate of return, the premium for bonds is falling and going below zero, we can see that gold does really well, and Bitcoin too. And so that relationship is really important. But look at where gold has gone in the past 10 years. So in the past 10 years, if you had bought gold, excuse me, if you had bought S&P 500 10 years ago, you are actually down money. Your portfolio might show a green number, but the purchasing power of that green number is lower than it was 10 years ago. So that is important with stocks. They can go up in nominal terms, but the real purchasing power value of those stocks might not go up very much. I mean, we have an analog to look at here. Um, this is the last time the U.S. had populism and kind of high spending, right, and populist economic and fiscal policy. We can see the S&P 500 went nowhere in real terms, and if in fact after the Nixon shot it, the S&P 500 actually fell in value. Now, in nominal terms, you won't see this, right? It looks like the S&P just went up. But the problem is that the monetary units, the purchasing, right, the money supply increased faster than the S&P 500 went up. So what that indicates is what we see here in yellow, which is a loss in real terms. I think that something like that is probably what we would see in the event of yield curve control, massive QE, liquidity where the government is intervening to artificially cap rates. I think the S&P 500 will go up in dollar terms, but I think divided by gold or divided by Bitcoin, I think it'll probably go sideways or down. And the same thing with real estate. I think real estate in dollar terms might go up, but in gold terms or in Bitcoin terms, it would go down. And so I'll show what that would look like. So here is the sales price of a house divided by gold. This shows the average the number of ounces of gold that you need to buy the average house. And you can see at whatever the current price of gold was at the time, right? So in 1980, it took about 102 ounces of gold to buy a house. Look at how many it took in 2000 in kind of the height of that dot-com bubble. It took over 670 ounces. So you went from it only taking about 100 ounces to almost 700 ounces. This is where real estate is outperforming gold, right? Well, what have we seen recently? We see the price of a house in gold terms is actually near historic lows. In terms of affordability, so what this indicates, a lot of people misunderstand this chart. What this indicates is the issue is not housing. The issue is the plummeting purchasing power of the dollar. And so, again, historically, ever since 2000, housing, I'll put it in here, single family home price divided by gold. Housing has underperformed gold. And if you look at it and divided by Bitcoin, it's even way, way worse. Housing has underperformed gold, right? The price of housing has gone up this time by a lot, but not as much as gold has gone up. And so again, this indicates that it's not the best store of value if you're trying to make a bunch of money. You know, the single family home prices might go up in dollar terms, but in gold terms, or especially in Bitcoin terms, they will most likely go sideways to down, in my opinion, if I had to guess. Stocks too. I think that they could go up in nominal terms, but divided by gold, divided by Bitcoin to account for the change in the money supply and the loss of purchasing power, they will probably go sideways to even down, which is what we saw with S&P 500 divided by gold, right? During the same period of time, housing underperformed gold. During the same period of time, the S&P 500 also underperformed gold. So anyways, hopefully that was helpful. Leave a comment with your thoughts, and I will catch you on the next one.